I just want to introduce this, then I invite another voice, important voice in Nabo Capital, the Treasury Solution Playbook. We have seen, we've been journeying together. We started with what problems are we facing as CFOs, isn't it? Then we looked at how would we structure a solution for those problems or to resolve those problems. Then we went to case studies, live case studies, stuff that has been done, which Charles did a fantastic job on. And now it's about you again. How do you come up with your own treasury solution playbook? I'm just introducing this, then I'll invite Mercy. So Mercy, get ready. When you have cash flow as CFO, this is how you should be thinking. First, do you have expensive debt? You have no business holding cash that is generating less than the debt that is in the business. So pay down the debt. Secondly, once you're done, you start with money market fund or treasury bills. Okay? Whatever is left, put in money market fund or treasury bills. And we said, if you're a big ticket investor, feel free to go straight into treasury solution. But we've all grown, we've all seen it's a journey that we need to grow into. Okay? From there, you can start going into term instruments. The beauty about money market fund and treasury bills are very short term. Liquidity is still going to be an important factor for you as a CFO. That is one of the biggest asks for the role of a CFO. When people need to be paid, they are paid. The organization has strong cash flows. So from there is term instruments. You can fix money for 1 year. You can fix money for 6 months, and the organization remains strong. By this time, you're accumulating your cash flows. You're probably now hitting, not just the operational reserve, not just your core reserve, you're entering also into strategic reserve, and you start handling the money that is available to the CFO to play around with starts becoming sizable, and that's why treasury portfolio comes in. And it's a full-time job. As Charles showed you, things change in the market. Yeah? What happened on October 10th? Anybody who remembers? What happened on October 10th? The largest or the biggest crypto crash happened, isn't it? Trump announced 100% tariff on Chinese goods, isn't it? And the whole world reacted. Yeah? $19 billion was lost in one day. And it is rumored that over 2,000 people committed suicide. I don't know how that can be verified, but even if one person lost their life, yeah, it tells us this thing we are discussing today called cash flow is a life and death situation. Sometimes you can lose so much money that you start wondering whether it is worth living anymore. What happened last week at Lake Basin Mall? Did you guys see it? Yeah? A very renowned engineer in Kisumu, he packed his V8, the guy looks like success, and he threw himself off, committed suicide. What was his curveball? KRA. They slapped him with a, is it 300 million tax bill? And he's like, where do I begin? Everything that I have built is gone. Remind me your name again. Ken. Ken, let me tell you something, Ken. It is easier to lose your own money than to lose other people's money. And CFOs deal with other people's. When you lose other people's money, they will turn hell on you. Yeah? So one of the guys who committed suicide, this one is verified, was called Konstantin Galish. He was a crypto influencer and trader. He had customers who had given him over $65 million. $65 million. And his life was set at 32 years. His life was set. You've met these people who are doing crypto. They don't believe anything can go wrong with crypto. Yeah? I hope I'm not talking to someone in this room.
Talking to us.
But in one day, he suffered so much loss that he sat in his Lamborghini and took his life. He took his life and wrote a note that it was too much to bear. So the seat you're sitting on is both very powerful, but also is a double-edged sword. It can cut you. It can destroy you. It can make you question who you are. So, when you're dealing with big money and you have many other things that you need to deal with, I would highly recommend, please work with a consultant like Nabo Capital to help you, not just to manage the upside, but also to manage the downside. Centum is an experienced investment company with over 50 years of experience. But what have they done? They've entrusted Nabo Capital, because Nabo Capital is specialized in those kind of products. They need to do real estate and private equity. If they start doing this, they'll get it wrong. They have enough firefighting to do. So I highly recommend, don't be like many other Kenyans who die because of this disease I call do-it-yourself disease. Yeah? You do not want to part with even a single shilling to be helped. Personally, as Pius, not as CEO of Nabo Capital, I also came to that conclusion when I discovered that my customers were making more money than myself. Why? Because in my calendar, there's nowhere to manage Pius's portfolio. So, I was losing money left, right, center. Yet I'm an investment professional. I'm a CFA charter holder. So it's not about expertise here. It's about your calendar. Does even your calendar allow you to do what you want to do? So, Treasury solution. When you have your Treasury solution, the other thing you'll be able to do now is to fund your capex. Most companies, when they are funding their capex, they borrow. But for alpha CFOs like yourselves, by the time capex requirements are coming, you already have a huge portfolio. And you put part of that money in your capex, you generate more cash flows. Those cash flows, you pump them through your treasury portfolio, and it's a cycle. It's a cycle. That's how you exhibit alpha-like CFO traits. And with that, I want to just invite Mercy to come and talk to us about this thing, treasury. Karibu, Mercy.
So my desired outcome from this session is two things. The first one is to talk about the Treasury solution the one that Pius has spoken to us about. And as MJ sets me up, we said there were 3 types of portfolios that you can set up under Treasury. Do we remember what they are? Who said yes? Yes, Walter. Say that again.
Operational,
Operational.
then core strategy and strategic.
Eish, let's clap for him. He's ready to execute. Thank you. So those 3. And to do this, I will use an illustration of a treasury solution and how we can really think about it as finance directors and CFOs. There's something that Pius has said, and we are huge believers of it, that every idle cash costs you. It costs you because inflation is higher than your money staying idle, right? But it also costs you an opportunity to generate an investment income line. So what can we do to help our companies to generate an additional investment income line? And how does this really matter? So Pius said you can, before we took our lunch break, you can think about one expense line item in your P&L, rent. Let me start as low as it is. It could be the tea lady's salary. Yeah? So we might not say we've got that 4 billion like centum. It could be a very small thing that you can operationalize your cash flows and you tick it off. So here we've got a live example of a company that came to us and we helped them to build that portfolio. For them, they wanted to meet their expenses. They also wanted to build a buffer against market volatility, and they also wanted to grow. And the 4 main cash flow drains are unpredictable inflows, seasonalities. COVID has happened. Your clients are not paying anymore. If we think about this hotel, the floods, the water has come all the way in that you have to cancel. And I saw yesterday you did a case study on the hotel that lost 2.5 million because of those cancellations. Manual forecasting, yeah, errors. At times we tend to overpromise. Then there's also idle balance, and I like the survey. The survey has shown that a lot of our cash is sitting in the current account. So how can we increase that? So for this particular client, they had about 100 million sitting idle in the current account, doing nothing. And when we presented the opportunity to them, we said, you know, out of that 100 million, you could have made 12 million that year. And you didn't wake up, you did not hustle. Who could use 12 million in their P&L? How much 12 million is a dot? Maybe we're talking to big organizations. But either way, it's not about the 100 or the 12 million. It's about the additional revenue that we can generate and optimize our cash flows. Whether you're an NGO, whether you're a SACCO, whether you're in hospitality, whether you're in the energy sector, whether you're in financial and innovation services, whatever that is. But for us to be able to build and construct a treasury solution for you or a cash management solution, what we do is we understand your cash flows. So we understand your, Charles talked about asset liability matching. So how are you going to optimize? Rispa was telling me that, as an example, she receives cash now and she pays her payables after 30 to 60 days. So how can you optimize, Rispa, your cash flows through treasury solution? How can you automate your expense management, build a resilience buffer, and transform your cash into an excess asset? So what we did with this particular client is they needed a high liquidity. So the first thing is to understand your cash flow cycle. Yeah? These are your days payable, your days receivable. What is that extra? It could be money that's staying in the account for 10 days. It doesn't matter. Don't think about it as money that has to stay in the account for a long period of time. Yeah? So as long as cash is in your bank account, it should always be earning money. No idle cash, right? So for this particular client, they needed a highly liquid solution. They needed something that would allow them to call the money anytime to pay their suppliers. Yeah? Charles spoke about some funds, and also Pius alluded to some funds under those 3 portfolios and operational. So for this particular client, out of that 100 million, what we did is we understood their requirements. And one of their requirements was liquidity. Well, the people on this side can't see. Can you see? You can. Okay. Liquidity. So when we draft a solution for the client, what we do is we look at what investments, assets would allow for liquidity. Okay? So because this is Treasury, pure play Treasury. Under pure play Treasury, liquidity was a key concern for the client, yeah? So their 100 million with this liquidity solution we provided was able to generate for them 12 million of additional revenue that went towards the expenses. And the evidence of the alpha is that bank deposits, we have some cash. How much are we earning in bank deposits? 6. Thank you. And the advantage of the bank deposit is that it's also highly liquid if you've got a good relationship with your bank, yeah? And if you don't, they might penalize you, but I'm sure all of you have some good relationships. So will you prefer to earn 6% or 12%? 12, yeah? Treasury bills, 10%. On the dollar side, for our audience here who receive funding in dollars, your bank deposit rate is anywhere between, so right now, 4%, against approximately 6%, 5.9%. Yeah, these are effective yields right now. And as a CFO, aside from optimizing, it's also generating a good yield based on what your requirements are. So that's what we did for that particular client. I want us to move to the crafting of the investment policy statement so that we make it a bit interactive. So those are some of the options that we prepared for this particular client. We said option 1, you could have 10% of your money in money market fund. You could have 10% of your money in fixed income fund. They had some dollar deposits. You could have some mix in dollars, in Nabo income fund. But then your liquidity. So aside from just saying, here you'll make 11.38%, we also look at the liquidity buffer. What is the liquidity index of that particular portfolio composition? So down there, herein, oh, it's not connected. Down there, you see liquidity number 4. So our ranking of that particular portfolio, and a portfolio is a composition of assets, is number 4 in our ranking. Number 2, we just changed. We left money market at 10%. We increased the fixed income to 20%. We decreased the allocation to the money market fund USD from 10 to 5%, and we came up with an expected return of 11.3%, with a liquidity rating of 3. Okay? I'll explain why. Then we looked at option 4. We increased the money market allocation to 50% and said we're just going to do Kenya shilling denominated investments. And the fixed income allocation, we increased it to again 50%. So we just said we'll invest for you in 2 asset classes, and the liquidity metric is 2, so it's better than the last 2 portfolios, and your expected return is higher. So please just look at option 3 and 4, okay? Stay with me here. But as your portfolio manager, our work is to understand Nabo's ethos is investing with purpose. We listen to you and we understand what your needs and requirements are. As an example, Charles gave 2 examples of 2 clients. The first client wanted a growth portfolio. They wanted to generate high returns. The higher the return, the higher the risk, yeah? The second client he presented, they've said, we don't care about returns. We care about safety, okay? We care about safety. So this client told us, we care about liquidity. We might give you that 100 million now. Next week, we need 80 million. We might bring it back. Then we might call it again. So we recommended that they put 100% of their money in the money market fund for the first 6 months to allow us to understand their cash flow, how their cash flows move in and out. Like, are they requesting for more money? So it helps us to build that relationship by understanding whether they've got steady cash flows or they're calling in and depositing. So that is why we recommended. So the yield is lower, but the liquidity metric was the most important thing to this particular client. So that's what we presented to this client. Then the second scenario, the client said, I want you to consider that I will invest a minimum of 100 million. I will give you 15 million when I make my collections. I'll sweep it directly. But at the end of the month, I'll need that 15 million. I want you to see how this portfolio changes in comparison to this one. So this one, what's their monthly income, investment income? Down there. Down there. 580. That's their investment income per month. This is just 10 million. Here they were putting in an initial capital of 60 million, and they were going to put in 10 million and call in 10 million. So we generated this for them to be able to see what that portfolio could look like. And at the end of year 1, this was in Q3, they will have closed the year with 62.9 million, an additional 3 million that they did not have. Yeah? By 2030, if they just retained 60 and they're doing 10, calling 10, doing 10, calling 10, because of the compounding, that little, you're compounding for 15 days, for 18 days, that portfolio will grow to about 111 million, okay? The second scenario was, here again, strictly highly liquid. The client is investing 100 million. They're topping up 15 per month, redeeming 15 per month. We are targeting 12%, and the duration is 10 years. This particular client, their average monthly income increases from 581. Dorcas, can you come help me with the toggle? It increases by 1 million. Do you see that? Here. And they close the year, in 1 quarter, they will have made an additional 4.8 million just because of optimizing their cash flow. And by 2030, this portfolio will almost have doubled, an additional 85 million because of operational efficiency. So what can this client do? They can invest in additional capex, yeah? They can buy another business, cargo. You can now come and construct Nokras Naivasha, at a Nokras Dubai. You can do regional expansion as... It's okay. Okay. Yeah. because of that particular growth in the portfolio. Then they threw a ball curve to us and said, we want to be able to pay a facility that we're servicing of 3 million per month. 3 million per month. What size of portfolio do we need to have? Again, because we're a goal-based investing house, we listen to you, then we tailor for you the investment solution. So no investment solution in Nabo for our institutional clients looks the same, because every business is different. There's LSK that is here, the SACCO. You need high liquidity, yeah? There's no crash. Your inflows are seasonal, yeah? You have William here. Your business is fintech, meaning high volumes, yeah? So how do we generate for you something that works for your own company? So this client, we worked on the portfolio simulation. For them to be able to cover a facility fee of 3 million, they needed an initial investment of 320,000. They said, this is so good to know, because now we can work towards something. We can give you the 100 million and build up to this 320,000, okay? Million, sorry. I want to call Fred to take us through the IPS, then I'll come back here. How to build an investment policy statement that works for your company, and then we're going to do some simulation for each company, so be ready. We're going to be standing, and I'll close with how to convince your board. Who needs to convince their board? So msitoke, don't leave the room.
Thank you, Mercy. I thought you were going to finish everything. Thank you. Good afternoon once again. Yeah, so a lot have been said, good, great stuff, but the question is, how do you make that decision to allocate 10% to money market, 30%, to T-bills, 50%, to Eurobonds? You have to have a guideline. So in investment, there's something we call an investment policy statement. It's like you're a recipe for those people who are chefs, Norcas hotel. For you to make a certain type of food, you must have a recipe that guides you how to make that food. Same applies to investment. For us to design that investment strategy that applies and replicates what the company wants, we come up with something called investment policy statement. So what's an investment policy statement? An investment policy statement, it's a guideline that will guide a company, an investment entity, or just even an individual who wants to invest their money. So that's where a fund manager like Nabo will come in and follow that procedure, how to invest on your behalf. Because you can't be calling Nabo every day, please put for me money in bonds. It will be another job you'll be doing instead of creating opportunities for the company. So basically that's what an investment strategy is. And I'll just take you quickly how the framework works. So for you to design an IPS, I will be calling it an IPS, just a short form for investment policy statement. You have to have some frameworks that you need to follow. So first, let me use budgeting. So budgeting, I'll go to budgeting CFO and ask him, what's your risk tolerance? What's your objective? What's your investment horizon? What's your short-term liquidity needs? Do you need to be getting funds maybe in short-term, long-term? So with that information, you can easily dictate how you're going to structure that investment policy statement. So the first one is coming up with that blueprint, which is basically sitting down with the client. We'll be helping you guys to put this strategy in place. We'll not be leaving you that work with CFO, because we know also that's an additional task. Sorry? Is it free? Yes, we'll do it free for our clients. Yes. And we hope you invest with us as we do that. So the first step is define the investment objective. Define the investment objective. Paya spoke of 3 tiers. Tier 1 was more of operational. Tier 2, it was more of medium, short-term needs. Then tier 3 was more of long-term strategic objective. So you need to define your objective. If you are someone who's coming in and say, Fred, I pay my expenses every month, and I need this money to be coming in. I receive receivables, I send it to Nabo, but I need this money also to pay my salaries and my expenses, monthly expenses. You see, that's a short term. So when you're structuring this IPS, we'll have that in mind. We know that budget will be needing 5 million in the next month to pay. So for us, we'll just even automate the process. We'll just know you're paying your salaries probably. I get my salary on 24th. My finance there is very... So we know 24th budget, he pays the salary, pays the expenses, pays the tax. So by that, before that 24th, we can always already have in process to have that funds already in your account, so that you don't even have to sort of come back and say, Nabo, we need this money. So that you don't feel that I should have put this money in the bank, I will have gone through this process of starting to beg Nabo to send me back my money. So with that IPS, it helps sort of to have that in mind. The second one is checking on risk tolerance and constraints. Charles initially spoke of stages at MSP portfolio, dubbed Centum, how it grew from being a growth portfolio to a very conservative portfolio. So it started from growth, defensive, and now very, very conservative. So with that one, we assess that one using the second framework, whereby, for example, a return is made of many factors. I know yesterday I was speaking one of attendees here, William, and William was asking me, why is money market 12% and why is fixed deposit 6%? That's a very good question. Then I just realized we need to understand the components that make up the return. For you to understand the risk tolerance and your constraints, you need to know what makes up the return. What level of risk can you take? So quickly, allow me to do investment 101 class. So return is made up of almost 5 components. The first one is the risk-free rate return. This is the return. There's zero. You're sure you're going to get it. So this is called the risk-free rate return. The second aspect that forms part of the return is something that we call inflation premium. So if the country's inflation is, let's say last day we saw 2 years ago, 18 months ago, Kenya was around 9 to 11, thereabout. And you saw even the bonds were trading around 18%. We saw money markets, some funds were giving even 16, 17%. The reason why, because that's risk-free rate return, we added back the inflation premium. Then there's maturity premium, there's deep. So if you're investing in a long-term bond, let me just use 2 funds. If you're using money market and fixed income, money market is more of a longer kind of product compared to money market. So that's why the return for fixed income funds will always be slightly higher than money market because of the maturity premium. Then you have default premium depending, we just saw Ghana, if you're investing today, if you're investing in corporate paper in Ghana and corporate paper in Kenya, there's, as Charles has mentioned, there's high probability of default in Ghana. So it means you have to have that default premium part of your return. And that's why corporate papers in Kenya, like a UBL, will be doing 11.8%. If you go to corporate paper, the same in Ghana, it will be around 25% and more. So basically, there's a lot of components that makes up the return. And that's why even liquidity premium. That's why, so when we go to framework number 2, we assess of some of these things. If you can take this risk, this is the additional what makes up that return. The third framework is developing the asset allocation strategy. So once we understand the objective, the risk you can take, and what you cannot take, then you can tell you, this first will give you the first draft. We'll just tell you this is how the allocation will be. let's say 20% in money market, 30% fixed income. The other 50% we can put in a locked, maybe at 12 tenor product like corporate paper. So with that, you see it has been guided by the first two aspects. The fourth one is more of governance structure. So this one, again, the board will want to know your investment strategy. So the IPS, it's just a schedule or a schedule within a fund management agreement. So, for example, Nabo will sit down with the client, will put down a fund management agreement, which will entail how this investment or how this portfolio is going to be run, how the return, what's the anticipated return is not guaranteed. Again, fund investments, we don't guarantee returns. So that's literally how the fund management agreement will look like. Then the vehicles, now these are just forming part of the allocation. So basically that's an APS, investment policy statement. So for you to even come with those different portfolios, you have to have this in place. You can't invest without have a guideline, even for individual. Thank you.
Well done, well done. Thank you so much, Fred. Fred was going to take us through Investments 101, and I liked what he said about the risk tolerance here. And at times we structure the investment policy statement for our clients, but here there's an evaluation, something happens in the market, and we quickly have to make that call and give you a call and say, Lois, this is what we are seeing, that the Kenya shilling is quickly depreciating against the dollar, your portfolio is skewed towards the Kenya shilling. Do you want to get some dollars? So one of the benefits that you get, which Fred has spoken to, is that we are consistently looking at the risk. We're looking at your risk, but we're also looking at the market risk, we're looking at regulatory risk, and we're also looking at your organizational risk, because at times you start when you've got high cash flows, but then your needs also change. And the other thing is, under monitoring, we are not only tracking the performance, we're also tracking the risk. There's something called value at risk. So we're looking at what's the value at risk. What if you've invested this 100 million for this client in money market fund, and there's something that happens from a liquidity perspective, what's the value at risk metric here, and how does that comply with the investment policy statement? And not only do we do this, we also come and report to your board on a quarterly basis. So we support you as the CFOs, as the finance managers. We're not just sending you a report and throwing it to you. You'll receive a quarterly report from us that will show you this is the investment policy statement, this is where we are, because within the investment policy statement we had said 50% in money market, but right now maybe 70% is in money market. Why? Why is 70% in money market? Okay? I want us to do a collaborative IPS drafting exercise. I'll speak to it. And I'll also have my colleagues help, because they didn't know this. So it's a case study where we're going to draw some insights and strategies from what we've learned. And in this case study, the first case study is hospitality. Guys in hospitality? You in hospitality? La? Yes, you're in hospitality. So here we're going to be looking at hey, that's a nice picture, MG. Thank you. Seasonal cash flow challenges. 5-star resorts in Mombasa and Naivasha, they've got 50 to 70% occupancy swings between the seasons, and they need to maintain 6 months of operating expenses during low seasons while still maximizing returns on high season supply. Galgalo, I can see you shaking your head. Yeah? It has spoken to you. Okay, that's the first case study. The second one, energy. Energy people, we're here? Okay, fantastic. So energy, we call this Petrolink. The first company was called Blue Wave Resort Limited. The second one is Petrolink Distributors Limited. Theirs is cash flow and currency exposure, because they're importing oil in dollars and they need to maintain some reserves. So their payments and receivable timings causes FX exposure between Kenya shilling and the dollar. Their payables are in dollar, their receivables are in Kenya shillings. So they're an importer and distributor across East Africa, meaning they're also dealing with other currency, UGX, Tanzanian shilling, hey. Okay, and their patterns is that they import every 60 to 90 days, but their receivables are between 30 to 40 days. Herein, their challenge is to balance liquidity for operations while hedging against FX. Okay? Third one, NGO/foundation sector. Hope Bridge Foundation, their profile is that they receive donor-funded educational grants. Their patterns is that these grants come either annually or between 1 to 5 years with 70 to 90% restricted funds. So as we do this, we're going to go to the next forum. I love the challenge that Ronald threw to us on Monday. Do you remember the case study he shared about this CFO in a pharmaceutical? Remember? Mlikuwa mmelala? Huh? Who remembers? CFO in a pharmaceutical? You remember? By a show of hands. Huh? It wasn't a pharmaceutical? No, I'm talking about the one who developed a pattern. It was a pharmaceutical, wasn't it?
It was a research.
Yes, there was that. I was in class. Okay. So once you've drafted this IPS and you've left here on a high, you've left here on a high, and you want to win, how do you get the buy-in of your board or your owner? Yeah. Okay. Next challenge, tech. Digifin Africa. This is a fintech with irregular 12 to 24-month funding rounds. So they've got a burn rate high. They need to invest in what do you call them? Developers, yeah. So they're bootstrapping really, yeah. So they need to preserve capital for operations while still ensuring that no idle funds are left. And the last one is Unity Capital. This is a SACCO and investment group that has diverse portfolios. They've got saving products. They're into investments. But now the challenge with them is that they have member spikes of contributions and redemptions within so they need to maintain their liquidity spikes. So their challenge is to balance liquidity, yield, while maintaining regulatory ratios. They still have a regulator to report to. Tuko pamoja? I'll send this in the WhatsApp group.